So let's talk about return on investment. It's a key metric to understand for multiple reasons. You can use it at a business level, marketing level, marketing campaign, all the way down to an individual ad. So ROI is calculated as total benefit minus cost to achieve that benefit divided by the total cost to achieve that benefit. Then that'll be a number likely between 0 and 10, 11, basically depending on the quality of the campaign, and you times that by 100%. So what is the benefit? The benefit can be revenue, it can be profit. Now, what's important is that you don't just look at ROI based on revenue. So if you have revenue minus cost divided by cost, you're going to get an inflated figure. It's still an important thing to look at a very high level, but you want to also look at the profit, because if you just look at one and not the other, you can very quickly run out of cash flow. So I want to give you an example. So let's say that you generated 10,000 revenue from an ad campaign. Total marketing costs were $1,500, right? You know your average profit margin is 60% from the budget, what you did earlier in the topics. So ROI on revenue, so the benefit, 10,000 minus the cost, 1,500 divided by the cost. So that's 8,500 divided by 1,500. So you've got an ROI of 566%. That's good. But it depends what your ROI on profit is as well. So we know that your profit margin is 60%. So therefore 60% times 10,000. So you got 6,000 profit less from your revenue, 1,500 for marketing, marketing costs taken away from that divided by the marketing costs again. So you got 4,500 divided by 1,500, which gives you 300%. So your ROI on profit, if this is less than 100%, you need to address it fairly urgently. If it's negative, you're losing money and you need to stop that campaign immediately. This is something that you need to monitor on a small scale, but also a large scale, because when it comes to ads, there are fluctuations, right? Some weeks will perform better than others. So you're always best to look at a 30-day rolling average when it comes to ROI on ads, but ultimately look at it on a weekly basis to start with. And so every week you'll have, you'll know what you'll be looking for. You're looking for the ROI profit of above 100%. And if you're getting there every week, well, then you're fine. If some weeks are getting it quite high, other weeks are getting negative, well, then look at the 30 days, because as long as over 30 days, you're at over 100% ROI on profit, then you're doing fine. So really important to remember a few things. One is to lock in the time frame reference for both the benefit and the cost. So you don't want to be looking at, for instance, the revenue generated over 3 months, but only the cost from 1 month. That's going to skew your data. That's not a fair analysis. You want to be true to yourself, because if you're not true, this again is how you're going to kill your cash flow and kill your business quite quickly. You can apply the ROI calculation to a singular ad or a whole campaign. In Facebook Ad Manager, you'll have a ROAS, which is return on ad spend, which again is good for measuring the ad performance. And you should be aiming to get a 3 or a 4 ROAS or above, because that's not including all your other costs associated, right? So if, for instance, you've got a ROAS of 4, it means that for every $1 you spent, you've generated $4, right? So therefore, your profit from the ads, but I'm saying profit in inverted commas, is $3. So spend $1, got 4 back, that's 3 left over. So that is a ad cost of 25%. Now, if you're, so go back to an example, if your profit margin is 60% and that's before marketing, then you have 60% left over to in wiggle room. If you spent 25% on ads, then that leaves you 35% left over to for other marketing costs, whether agency costs, your own time, whatever it is. So you always need to be analyzing the profit that's being left over. And ultimately, the only profit that really matters, it's what's left over at the end of the day. The only profit that really matters, because you've got gross profit, net profit, you've got a bunch of operating profit and a bunch of different profits out there. Make sure you calculate once everything is taken out. Don't miss any specific expenses. It's really important that you include all the potential expenses, because otherwise you're going to shoot yourself in the foot. And also a really important factor that people often forget is to include their own time, right? In a day, you want to be paid out of this brand. So you need to make sure that you include your charge rate into your calculations. So if you spent 10 hours on a marketing campaign, that's like creating the copy, setting everything up in MailChimp, in Facebook Ad Manager, that's 10 hours of your time that you should be paid back. Because if you're not paying yourself, you should be paying an agency, you should be paying someone. People don't work for free. So just make sure that you include your own time in the costs.